Welcome to Thoughts on Investing. Today, we're digging into a story that really shook up the market, PayPal's massive stock plunge. I mean, how does a fintech giant like that just lose almost a fifth of its value overnight? Well, it turns out it was a perfect storm of bad news. And we're going to break down exactly what went wrong. All right, before we jump into all the juicy numbers, just our usual but very important reminder, this is all for educational purposes. We're here to understand the story, not to hand out financial advice. You know the market can be a wild ride, so please always do your own homework before making any investment decisions. So let's start with the moment all the alarm bells started ringing, and this wasn't some slow, gradual decline. Oh no, this was a sudden, absolutely brutal reaction from the market right after PayPal's latest report came out. On the day of its big announcement, PayPal's stock didn't just dip, it plummeted. We're talking nearly 19%. For a company of this size, that's not just a bad day at the office, it's a catastrophe. Billions of dollars in value just gone, in a matter of hours. It sent a massive panic signal to investors everywhere.
And that brings us to the big question, right? What on earth could cause such a huge sell-off for a household name like PayPal? Well, as you're about to see, it wasn't just one single thing. It was this lethal combination of problems that all hit at the exact same, worst possible moment.
To really get why everyone freaked out, we have to look at the data. The first signs of trouble, the first cracks in the foundation, they all showed up in the company's fourth quarter results for 2024. So let's dive into those numbers.
Okay, take a look at this. Wall Street had a number in its head, about $8.79 billion in revenue. PayPal came in at $8.68 billion. Now, on paper, that doesn't seem like a world-ending miss, but in the high-stakes game of market expectations, it's a failure. For a giant like PayPal, even a small crack like this is enough to really spook investors.
And the bad news just kept on coming. The exact same thing happened with their earnings per share, or EPS. That's basically the company's profit split up among all its shares. The market was hoping for $1.29, PayPal delivered $1.23. So now you've got two big misses, revenue and earnings. That's a classic double whammy that has investors running for the door.
Now, if you dig a little deeper, the story gets even more interesting. Their total payment volume, that's all the money moving through their system, was actually up 9%. Sounds pretty good, right? But here's the catch, and trust me, it's a big one. The most profitable part of their business, what's known as branded checkout, when you see that classic Pay with PayPal button, that grew by a tiny 1%. So what does that mean? It means they're moving more money, but making less profit on it. And that, my friends, is a huge red flag.
Look, a miss on earnings is one thing, but that alone doesn't explain a 19% collapse. What really turned a bad day into a total disaster were two more bombshells, a really bleak outlook for the future and a sudden, shocking change in the CEO's office.
This is what truly terrified Wall Street. When they were asked about the year ahead, about 2025, management's forecast was grim. They basically said earnings would be flat or maybe even down a little. For a tech company, no growth is pretty much a death sentence. It told the market this wasn't just a temporary hiccup. The company itself was preparing for a long, difficult year.
And then came the knockout punch. In the very same announcement, PayPal revealed that its CEO, Alex Chriss, was out. A new CEO was on the way in. Announcing a leadership change right in the middle of an earnings crisis is like the ultimate signal of chaos. It basically screams to the world that the board has lost faith and is smashing the emergency reset button.
So let's recap. You've got missed numbers, a weak forecast for the future, and a CEO getting swapped out. How did the market react to this triple threat? Well, the verdict was swift and it was absolutely brutal.
This right here really captures the perfect storm. You have the earnings miss, the terrible guidance, and the CEO swap. And you have to add that to the worries that were already there, the slowing growth in their most profitable area, and the fierce competition from rivals like Apple Pay. Any one of these would be a serious problem. All of them hitting at once, it was a recipe for disaster.
This quote just nails the mood perfectly. The feeling out there was just overwhelmingly negative. I mean, after that tidal wave of bad news, investors looked at PayPal and just saw no easy way out. There was basically zero reason for any short-term optimism.
So, that's the story of the collapse. But what happens now? What's the path forward for PayPal as it tries to climb its way out of this massive hole?
When you boil it all down, it comes to this. PayPal has to find a way to grow again. and they have to do it in a world that's packed with aggressive competitors. The new CEO has a monumental challenge ahead: restore confidence and execute a flawless turnaround. For now, with the stock sitting at historic lows, the market is very, very skeptical. The real question isn't just if the new leadership can turn the ship around, but whether the ship itself is even built for the stormy seas of modern finance.
And that's the breakdown of PayPal's perfect storm. If this helped you make a little more sense of the headlines, do me a favor and hit that like button and subscribe for more deep dives just like this one. Thanks for watching.